Okay, right on. We're going to start chapter 6 today. First, before we start chapter 6, show of hands, who has taken financial accounting class or is currently taking a financial accounting class? So that's like principles, intro to accounting, even if it's high school. Okay, so only a couple of you haven't had any, like you have no financial accounting background. So debits, credits, or have any familiarity with that? Okay, so most of you do, some of you don't. So that means that this chapter is going to be, for most of you, it's going to be kind of a lot of review, and it should be, fairly understandable, especially if you're good with financial accounting and you're good with those debits and credits, financial statements and that sort of thing. For those of you who have not had any financial accounting, don't even know what a debit or a credit is, I am going to go through on a basic level how that all works, but just understand that you may have to do a little bit more work on your own to understand that whole concept of the debits and credits, because they're, obviously we have 4 or 5 classes here at DMAC that cover all the concepts of financial accounting, so it's more than just a couple of lectures worth of material. So just understand, some of you, this chapter is probably going to be fairly, I don't want to say simple, but maybe not the challenge that the other chapters were, because it's not entirely new information, but for some of you it is going to be a little bit more challenging, and you might have to put a little bit more effort into understanding it if you don't have that accounting background. Okay? So, because what we're going to do in this chapter, so up to now, obviously you guys are familiar with what we've done. We've done all of the calculations to determine what our gross wages are, and then done the calculations to determine what income taxes, Social Security taxes, Medicare taxes, FUTA taxes, SUTA taxes, all of those amounts would be related to the payroll amount. So now what we have to do is learn how to integrate that information into the financial accounting system. This is not something usually that is done by the payroll department. Kind of depends on the size of the company. If it's a smaller company, then they may be involved in some of the accounting part of that. Payroll may be involved in some of the accounting part of the tasks, but usually this is these journal entries and entries are made by the accounting department, not so much by the payroll accounting department, but the information that is received by the payroll department is integral to the proper accounting for all of those transactions. So obviously payroll is a huge part of most organizations' overall budget, right? Usually for most companies, it's their single largest expense category is what they pay their employees, their greatest asset. And so it's imperative that the information be recorded into the system properly. We're going to go through, first off, we're going to look at, and I actually didn't put this agenda together quite right. This information is probably what we're mostly going to go through starting next Tuesday rather than today. What we're going to start with today, we're going to go back to the slides. We're going to revisit the payroll register and the employee earnings record, because those documents are needed in order to record the journal entries into the financial accounting system. The information that's gleaned from those. So we're going to do a little review of the information that's on those reports. Then we're going to talk about certain types of deductions that we really haven't talked in detail about. We're not going to get into a whole lot of detail today on those deductions, but these are things like health insurance that is deducted. We've talked about some of those deductions with regard to whether they're pre-tax or post-tax, but we haven't talked about them specifically about those deductions, what they are, what they entail. So we're going to go through a list of different types of deductions, including garnishment. So the deductions fall into two different types of categories. Voluntary deductions, so those deductions that the employee has chosen to have taken from their paycheck, and then involuntary deductions, those amounts that are not, the employee has not chosen, but they are still subject to. We're going to go through and talk about those different types of deductions, how that, again, affects the net pay. Then we're going to get into recording and journalizing the entries, the necessary payroll entries into the financial accounting system. So we may get into part 3 a little bit today, which is where our agenda kind of starts off. Journalizing and recording the payroll and payroll tax entries. There are 4 main entries that occur with regard to every payroll that takes place. And we'll go through those 4 entries and what they entail. And then we're going to talk a little bit about the how, once we've made the journal entries into the payroll system, what happens at that point, then posting those entries into the general ledger, and then how that all integrates into the financial statements for the company. We'll look at how we record in the accounting system the deposit of those payroll taxes that have been withheld, what that journal entry looks like. And then also we're going to finish up talking about end of period adjustments. So adjustments that need to happen mostly because of timing issues that may occur, a difference between the timing of the accounting period and the payroll period, because those don't always jive up. Obviously you may have, especially if you think about the calendar and the fact that, so let me just pull up a calendar here. November's not a good example. December's a good example. So you can see like the end of the month ends on a Tuesday. If we have a payroll that was we have a pay period that ended on the 27th, and we started a new pay period on the 28th. Well, the 31st would be the end of an accounting period, but it's not the end of a payroll period, right? It's in the middle of the payroll period. So we've got an adjustment that needs to be made to account for that timing difference. So that's the last thing that we're going to take a look at in the chapter. So just to kind of give you a little overview of what it is that we're taking a look at. So let's recall the payroll register. And remember, the payroll register has all the information about gross payroll, withholding, net pay, any tax withholdings that have occurred, any other types of garnishments that have occurred. It's got all that information for a particular payroll. So it would have it for every employee for that payroll period. Anything else I want to say? So if you guys can remember to visualize what that looks like, it's not on a per employee basis, right? It's for the entire payroll. So every time a payroll is run, even if it's a special payroll, which can occur, a special payroll meaning outside of the normal schedule, every time that occurs, there's going to be a payroll register that coincides with that that particular payroll. One of the things that's necessary, they're referencing, and I don't have the book out, maybe I should have pulled it out, but just to kind of remember, well, maybe I will pull that up. Give me a minute here, just so we can take a look. right, so just kind of a reminder. I don't know if this is going to help at all. No, because it's going to turn it on its side, or it's going to do that. Yeah. That's a little bit better. All right, so just kind of a reminder of what that payroll register looks like. Where we've got all of the employees are listed. There is some information here about now on this one, they've got an example of the number of withholding allowances. As you recall, that would be using the old method of the pre-2020 method of withholding calculations. A payroll register nowadays probably wouldn't have that on there. As well as they do have filing status. All of the time now this particular one has all the time that each of these employees worked, the rate that they are paid, the amount that they're being paid, the gross amount that they're being paid. If there's any overtime as well, there's a separate column for that. And then the second part of this, the second page starts with the total earnings, and then these would be all of the deductions that occur from each payroll. So we've got our taxes over here, FICA, OSCI, HI. You know how to calculate that amount. So if you remember back when we started this class, you looked at this payroll register. I told you eventually you're going to be able to calculate all of that stuff, all of those columns. Well, now you know how to calculate all of those amounts and what information you need in order to do those calculations. Federal income taxes, withheld state income taxes. There's a column for group insurance. The check number indicated how much the net pay is, and then over here to the right of that is the amount of the employer's portion of all of those taxes. So we've got the deductions, the amount from the employee paycheck, and then the net pay, but then in addition we've got the amount that is owed by the employer. And here they've presumably there might be some more columns there to actually calculate out, or these are the taxable earnings. And then those taxes themselves would be calculated separately. Now, one of the things that needs to happen, and this is something that, you know, with software and spreadsheets, it's probably not done quite as much as maybe it should be done. Where'd I go here? Is that all of the numbers need to what we call foot. Meaning all of the numbers to you total all of the amounts over in the rows, and then you total all of the amounts in the columns. Everything should agree. So there shouldn't be any difference. So for example, on this one, where are we? We have net pay for each individual employee. We would also want to make sure that down here in the totals that the gross earnings minus all of these deductions equals the correct net pay. So making sure that all of that agrees. And again, you know, using spreadsheets is certainly helpful for that. In the olden days, you'd have to do that manually. But, and that's what they're talking about here, footing or proving the payroll register, ensuring that the columns and the rows all total to the bottom right-hand number, that ultimate net amount of pay. So that's the payroll register. Just a reminder then of the employee earnings record. So the employee earnings record is per employee. So this is each employee is going to have an earnings record, and it's a cumulative record of the total amount that is paid to that employee, as well as a cumulative amount of all of the withholdings, the taxes, the garnishments, the benefits that have been paid, and all of that. So the employee earnings record is used to help prepare the payroll register. It's also helped to used to prepare reports required for state unemployment. Remember when we did the state and the FUTA calculations, we needed to know on a cumulative basis how much employees had been paid. So because the employee earnings record provides that information, when we're doing the FUTA and SUTA reports, we would get that information from the employee earnings record, right? The payroll register is not going to tell us on a per employee basis cumulatively what has been paid, that's only giving information, a snapshot of what happened for that payroll, whereas this is more of a movie. It's a film from start to finish for each individual employee. Those accumulated wages are used, so again, for the OASDI taxes as well, this helps us to determine whether somebody has met that Social Security wage base, the $160,200. Can also be used to, there are certain governmental agencies that will send out reports to employers asking them to fill out just to get an idea of what the workforce is looking like, where they've seen increases in certain areas and decreases in that. So certain governmental agencies will send these out, and the employee earnings record can be useful for that, filling out those types of records as well. The payroll register also is useful for that. Also for internal management reports. So these, the employee earnings record can be used by cost accountants to help determine where labor should be placed within an organization. So not just used for preparing the 941s and preparing the 940s and the W-2s, obviously at the end of the year, but also used internally by management, also used by labor unions as well, may require information from some of these reports. So it's information that is used by all sorts of different users to get a snapshot of what's going on with regard to payroll in the organization. As they mentioned, can help to settle employee grievances. Hey, I wasn't paid for this time. It's not showing up on my paycheck. Well, it can be used to determine whether that is accurate, and then also to issue those W-2s. But the information from, and we'll just, let's see, do they have an example? No. Oh, this is still proving. Oh my goodness. Oh, they give you like one paragraph for each of these. There we go. I know that's awfully tiny. So this would be, again, for one particular employee. We've got Chris Collins is the employee. She's an administrative assistant. It has her tax information, looks like down here as well. I know this is cut off a little bit. But we've got this cumulative, so we've got information for 3 different pay periods listed here, what she was paid, and then over to the right-hand column, the far right, so we would have the cumulative earnings that have occurred. And obviously, this software does this stuff for you, generates the report, can also be exported into Excel. Like if you're using QuickBooks, you can export these reports into Excel so that you can kind of manipulate the information. This particular report, I don't know, I guess they've got the totals. Well, they don't have the totals down below. But if you wanted to know cumulatively, how much FICA had been paid by Chris year to date, the software can help you to, obviously can help you to do that stuff. All right. So let's talk a little bit about, actually I think I want to, first. No, I guess. All right, so when we make the first journal entry, I'm just saying we have to talk a little bit about what accounts we use when we are recording these entries. Generally speaking, there is, in every organization, there's what's called a chart of accounts, and it has the listing of account names. These are not standardized in that each organization gets to choose what they want to name their accounts, and usually there's a number that is also associated with account names. There are some best practices with regard to naming these accounts, but there are no requirements for it. A lot of times we'll have a title such as wages expense or salaries expense. Now obviously it could be that salaries expense only pertains to individuals who are salaried. Wages could include both hourly and salaried. So the name that is chosen probably needs to best suit the company's needs and how they generally pay individuals. Usually if you have multiple departments, you're going to want to break those departments up. You're going to want to have account names for each of the departments. Again, that's not for external purposes. The IRS doesn't care. They want about what, whether the research department is being paid more than the sales department. They don't care about that information, but for internal usage and making management decisions, that is critical, usually critical information. So what oftentimes will happen is we'll have specific accounts, sub-accounts, essentially, to describe the general wages. So for example, they've got here wage expense research, wage expense technology, they've got down here, wage expense sales, wage expense administration, wage expense payroll department, so that you can, the more detailed you are, the more you can drill down into the information that is provided from the accounting records. So each of those is, so the gross, well, I don't really want to get into the details of the payroll entry at this point. I just kind of want to talk generally about the different types of accounts. So those wage expense accounts, we also are going to be talking about certain liability accounts. And if you recall, liability account is an account where you owe somebody something in the future, right? You've incurred the expense, you have the obligation. At some point in the future, the company is going to owe an amount. It just isn't owed right now. Well, if you think about what we've talked about with regard to withholding and payroll, obviously when we calculate payroll, we're not paying those taxes, those amounts that are being withheld, we're not paying them immediately, right? We're paying them on a schedule. Might be a semi-weekly schedule, might be a monthly schedule, might be a next day schedule, but we're not paying them right now. So we're going to have to accrue those expenses. So that means we've got a liability account that we have to generate in order to make those payments at some point in the future. So most of the accounts that we're going to be looking at are expense accounts, liability accounts, cash, obviously, we're also going to be looking at, but we're going to go into some more detail on those different types of accounts. Now, there are some other amounts. Every item that is withheld from a paycheck is going to have its own account. So if we've got insurance premiums, we're going to have an account that helps to account for the amounts of insurance premiums that have been withheld. Health insurance, savings bonds, I mentioned savings bonds here. So employees, depending upon the employer, may choose to have amounts withheld from their paycheck to then be diverted to invest in savings bonds or other types of investments as well. Union dues would be another amount. Garnishments, these are involuntary withholdings, those garnishments. Pension, retirement contributions, these are just a few examples of certain other types of accounts other than taxes that may be withheld from employee paychecks, and each of those categories would have their own account in the chart of accounts, right, in order to properly account for them. So we're just going to go through real quick here these different types of accounts that most of you are probably familiar with what they would be, but just to kind of give some definitions to them. So group insurance, in this case they're talking about like life insurance. Employees may be able to obtain life insurance at a lower rate than if they purchase it individually. So the employer can get a better rate for the employees. Under some group insurance plans, the employer and the employee share the cost of the insurance premium. Remember we talked about that group term life insurance, where if the benefit is more than $50,000, then the employee has to pay, at least has to pay some tax on some on the amount of that premium that's over 50,000, but there are also certain types of group insurance where maybe the employer and the employee will share the cost of the actual premium. What happens here is the total amount that is withheld is credited to a liability account, and then within that, and then the liability account is debited when the actual premiums are paid. And we're going to go through those. I know just saying credit and debit sometimes it's about as useful as explaining an algebraic equation. You have to actually see it. So we are going to look at these journal entries, but just know that I actually just want to focus on what these accounts actually are and how they're described. So health insurance would be another pretty self-explanatory. This is where the company provides the opportunity for employees to pay for health insurance through a group plan. Usually the premiums are much lower if it's through an employer's plan. And there would be a withholding amount for health insurance, group health insurance, if the employee has any responsibility toward that health insurance. The amounts are withheld from the employee's wages for health insurance, and then they're credited to a liability account, because at some point in the future that payment is going to have to be made to the health insurance company. The employer's portion of the premium, usually what happens is if the employer and the employee are paying for the health insurance together, like they're sharing the costs of it, the employer is going to pay the premium up front, and then the employee through withholding is going to repay their amount of that premium. That's generally what happens. Government savings bonds, so we're talking about like EE bonds or I bonds. Employees, if they want to directly invest in bonds, those amounts could be withheld from employee paychecks so that they can go ahead. So they never see the money, they don't have to do it themselves, the money just automatically gets diverted. Union dues, this is another big area. So employees who are members of unions, there are dues associated with that. It may be voluntary, it may be involuntary. I'm sure when you worked at the post office, there were were those mandatory union dues? No. Okay, because you were in Iowa at the time. Yeah, Iowa. So there are some state laws like Iowa. In Iowa, you can't be forced to be a part of a union. There's some states where that's not the case, where the employer can be compelled to be a union member, and you have to pay those dues. In Iowa, that is not the case. You don't have to. You can decline being part of a union if you wish. But if you are part of a union, then those dues, which are not pre-tax, you don't get any tax benefit from them, but those dues are withheld and then paid to the union at some point in the future. So when it's withheld, the amounts are credited to a liability account, such as union dues payable, and we're going to go through some of those accounts as well. And then when it's actually paid, you debit that liability account and credit the cash account. The cash is going out. Garnishment. So here we're talking about involuntary amounts that are involuntarily withheld. Could be child support. Could be that the employee has a court order against them. Maybe they have a debt that is outstanding and a court order has been obtained where the debtor or the creditor is receiving payment through withholding. When this happens, the payroll department will receive a notice indicating that there is some type of garnishment in place. The payroll department doesn't garnish wages until they receive that notice, and the amount is always indicated along with calculations of the maximum amount that can be withheld. There are lots of different types of garnishments. There are federal tax levies, so if you owe money to the IRS that is in arrears, they can garnish your wages in order to pay that. Child support as well is another big one. If you owe child support, and this is the priority of these different garnishments. So first up would be federal taxes and child support. Those would take priority because it's entirely possible that employees have more than one garnishment from their wages at a time. Bankruptcy would be next. And there are different types of bankruptcy. I don't know the specifics of them. I know there's Chapter 11 bankruptcy, Chapter 7, Chapter 13 bankruptcy. Certain types of bankruptcy take priority. So it says orders under Chapter 13 have the highest priority. And then we would have other types of creditors, like maybe auto loans, credit cards, that type of thing, student loans, and any other federal administrative wage garnishments would come in last in that priority order. There is a Consumer Credit Protection Act which limits the amount of wages that are subject to garnishments. So you can't take all of an employee's wages. You have to leave them with something to live on, even if they have these garnishments. The maximum amount of disposable earnings that can be garnished for debt repayment is whichever is less of these two. So 25% of disposable earnings for the week, so that means that they'd have to be left with 75%, or the amount by which the disposable earnings for the week exceed 30 times the federal minimum wage rate. So you'd have to do a calculation of those two. Also, they mention here, so Social Security can garnish without any court order delinquent overpayments owed by former beneficiaries of the Social Security program. So if they were no longer, that would be for like probably disability payments that were overpaid. Child support, we said that one, and the federal tax levy take precedence. The child support payments have to be immediately withheld. So once the payroll department receives a notification that there's a child support garnishment, the very next paycheck they would have to make that payment. Employer can withhold a fee for any administrative costs. So they can, if there's a child support garnishment, now it would have to be a reasonable fee, but they can tack on, $10 or whatever, and it's the employee that pays that fee from their garnishment. Again, this takes precedence over most other types of deductions. Let's see. Federal tax levy. This is usually second, even though it's one of the highest priority, it's second after child support. And again, this is when employees owe back taxes, both back federal taxes. Oftentimes what also happens is if they owe back federal taxes, there's a good chance they owe back state taxes as well, but those state taxes would take a lower priority from the federal. Takes effect within 3 days of the receipt of the tax levy notice with the first wage payment. So again, pretty much immediately. Let's see. So if the garnishment for these garnishments exceeds 25% of the employee's disposable earnings, no deduction can be made to satisfy the second garnishment. So that meaning that if the garnishment for, say, child support is already takes up 25% of their paycheck, then there's no other garnishment that can take place after that. None of the secondary garnishments can take place. So if they owe money on student loans or something like that, that is just going to have to wait until the child support obligation is satisfied. And then as well, pension and retirement contributions. This is another type of deduction from employees' pay. There are some employers that require contributions. If you're an employee of the state of Iowa, probably the federal government too, you're required to contribute to certain retirement plans. A lot of other private employers may not have that same requirement. It may be completely voluntary. So the pension plans, again, the amounts are withheld, and then a liability account is established and debited when those funds are collected, and then it's credited when they are ultimately paid. What else do I want to say about this? Not much. Like I said, I just really kind of wanted to go through all of those. All right, let's do these before we talk about the actual journal entries as well. Tax withholding errors. So sometimes we can, payroll departments can make errors with regard to how much was supposed to be withheld. This gives kind of an idea of when those amounts, when that should be corrected. So if a calculation was incorrect, you know, with regard to, generally with the income taxes, it depends on how much the error, how much they were in error, whether or not it's imperative that it's corrected. If it's just a few dollars, that obviously is probably not going to be corrected. But if it's a large amount of money, it needs to be corrected. Social Security, Medicare tax is more imperative that it be rectified. So if amounts are over withheld, then it needs to be corrected in the same quarter, ideally. If it's not discovered, then that's, so if they've withheld too much of the taxes, then the employee would need to be refunded those amounts, and then that needs to occur within the same quarter. Under withheld as well, so they haven't withheld enough, that also needs to happen within the same quarter. That means that your 941 is going to be okay if it's all within the same quarter, right? You're going to make that fix before you file the 941. You can also, and so ideally, if it's within that same quarter, you're going to be able to make that fix. Now, if it was over withheld, and you don't discover it until a later quarter, then you're going to have to make those adjustments. You may have to change 941s going forward. So there may have to be some adjustments. That's actually happened to me before. It's a bit of a nightmare when you discover an error, especially if you discover it when you're doing the W-2s. And because now it's the end of the year, and now you've got to go back and correct those 941s from the start. So anyway, I'm not quite sure why this slide is in here. Hold on a second. Not that one. I thought I had it in here. We're doing. Let me see I want to see real quick what the book has to say about the over and under. Doesn't have anything to say about it. All right. Okay. So different types of methods that employers can pay wages and salaries. I mean, they can pay in cash. That's really inconvenient. I'm not sure. I mean, I suppose if you're a day laborer, then payment in cash is probably possible, but you know, you're going to have a lot of cash on hand if you're going to do that. Checks, usually a separate payroll account is maintained. It says sometimes a separate, but actually that should always be. There should always be a separate payroll checking account that's available. To keep those funds, not to commingle those funds with an operating account, a general operating account. Electronic payments, obviously a lot of employees have their funds electronically deposited now, directly deposited. Makes payment a lot easier. There's no chance of the check disappearing or getting lost or being destroyed or anything. everybody's probably pretty familiar with direct deposit. That would be the most common method these days. There is another method that I don't know if any of you are familiar with, pay cards, where the paycheck is delivered on a debit card. You're nodding your head, Kayla. You have a...
I had one job where like that was the first thing before I got direct deposit.
Right. So with the pay cards, they cannot make you take a pay card. Debit card, it's like your payment comes on a debit card.
It's like a little leasing card type thing.
Exactly.
But it's
Right. It's got your paycheck on it, so everything you buy, you just use it like any other debit card. It's got that amount on there, and then of course as you get paid again, it's the balance is going to go up. And it helps for those individuals who don't have bank accounts. And there are actually a lot of people out there that do not have bank accounts. So it can be helpful in that respect, but sometimes as well, like the debit cards will charge a fee every month when you,
Yeah, I ended up getting it switched to direct deposit, like you can put it from the card to your account.
Yeah.
It was a little bit-
Yeah. So like, you'll get dinged $5 a month or something like that, and just for having the card. Also, it can be inconvenient. You can't write a check off of it. Like if you have a rent payment or something like that. Yeah. Did you experience?
Yeah, it's really, really inconvenient.
Yeah. So, and you're limited to how much cash you can get out of it if you go to just any other ATM limit on that. So it can be convenient for some people. For other people, it's probably a lot easier to just have a bank account, but there are a lot of people that do not have bank accounts, and there are various reasons that people may not have bank accounts. They may choose not to have a bank account, but the pay cards a lot of times are an option that employers are offering. They cannot force you to take your pay on a pay card, though. They have to give you the option of receiving it either in a check or a direct deposit. So, and I actually had a friend whose son was working at, it was McDonald's up in Mason City, and she called me up and she said, hey, he just started, he was a teenager, and he was given this debit card, and I don't understand, because she's like, I've never seen this before. And I said, well, yeah, they can do that, but they have to give him the option of having it deposited, because she's like, he doesn't want the debit card. He wants to just have the money into his account. And actually that particular McDonald's was in violation because they weren't giving people an option. And they do have to give an option. So just kind of one of those things to look out for, and a lot of employees aren't really aware of what their rights are there, but the Consumer Finance Protection Bureau does state that they have to offer at least one other option in addition to that, because it is not the most convenient way. Electronic pay stubs. So a lot of us, when you get your, well, even if you just get a paycheck, you may have a portal that you can go into to check what your the withholdings that you have and what your year-to-date amounts are. Some sort of electronic portal. Final pays. So this kind of differs from state to state when a final pay has to occur. And by that I mean when an employee is terminated or when they quit, when do you have to pay them their final pay? In Iowa, they just get paid on the next normal pay. So whether they're terminated or they voluntarily quit, they're paid whatever the next pay cycle is. That's when they're going to get their final pay. But there are some states that require have a different schedule for it. So like California and Minnesota require that they get paid immediately. So if you go in and quit, you need to come out with your final paycheck. They've got it. So the payroll department has to kind of be on call there to make sure that those calculations are done, and they have to be paid immediately. Some other states require. Remember, I lived in Arizona for many years, and I think it was within, at the time anyway, I think it was like within 3 business days, they had to pay the final paycheck to the employee. Federal law does not require any payment to workers for accumulated vacation time. There are some states, though, that do have a requirement to pay employees for accumulated vacation time. So I don't believe there's a requirement in Iowa to do that. A lot of employers do it anyway, or they may not pay for sick time. Like if there's a separate PTO, usually is something that is paid out because it's like it's earned. You earn it with every paycheck, so that would be generally speaking paid out. Something kind of interesting that maybe some of you don't really know about. What happens when somebody doesn't cash their paycheck? It actually does happen, believe it or not. A lot of employers are under the mistaken belief that, well, then that money just comes back to them, right? The check doesn't get cashed, and so, they don't have to do anything with it. That is not true.
All the ones I had from the post office said good for a year, printed on the paycheck.
Yes, it's good for it. Yes, exactly. So the employer does have to make a good faith effort to locate the employee and get them paid. So oftentimes this happens if, paychecks get lost in the mail, or the employee moves, or they left employment suddenly, and then they've just kind of disappeared, and they can't find them. So what happens with those payments is that the employer has to make a good faith effort to locate them. After a year, if they cannot locate them, then that money reverts to the property of the state. So the employer is required to then send that money into the state, and each state has their own fund, and then the state makes attempts to locate the individual that the money belongs to. So and in Iowa, I don't know if you're familiar with this, we always introduce this in this class, the Great Iowa Treasure Hunt. This is where the unclaimed property goes. And you can search on here to see if you have any money. It's not just for wages, it's for anything else. Maybe you had a refund that you forgot about, not just a state one, but a private, you got a refund from, I don't know, you bought something and then you took it back and you didn't get your refund, something like that. Anyway, any type of money that is owed to you, the employer and all businesses are supposed to then revert these payments to the state. So for example, if you're a vendor, let's say you're a construction contractor, and you send out a bill for work, they make the payment for the bill for the work, but you don't receive it. You forget about it. Hard to believe that people forget about money that's owed to them, but it actually does happen. Though that payment then is supposed to revert to the property of the state, and then the state makes attempts on that. So you can actually go on here and you can look up your name to see if anybody owes you anything that's sitting out there. You can see they've returned $384 million to Iowans. So let's see. So you can see if you have a business as well that is owed. So I'm pretty sure I don't. Your last name or your business name. Search. Let's see. There are some Kelly Westfalls and Kelly Murphys out there that are owed money. None of them is me. Barbara Westfall. And then they give you the amount. So you do have to make a claim for it, but that's where the money goes. You don't just get to turn around and put it back in your bank account. You have to turn it over to the state in order to make sure that the state then will try to locate that person. Payroll fraud. It's our last subject here before we actually take a look at the journal entries. So lots and lots of types of payroll fraud. And one of the reasons why it's really important for individuals who are in the payroll profession to be ethical. Now, has anybody ever heard of the fraud triangle? Do they cover that in? Okay. Do you remember what the 3 points of the fraud triangle are? So there's some sort of pressure. Oops, if I could just spell PRE. Is that right? No.
Yeah.
Why doesn't it look right? I don't know. What's another point?
Opportunity.
Opportunity. Right?
Rationalization.
Rationalization. Very good. So, and if there's a weakness in any one of those points, anybody could be subject to committing fraud, right? So pressure, usually this is some sort of outside pressure, maybe financial, maybe some addiction, you know, anything like that, maybe like a recent divorce or something, some sort of outside pressure that is weighing on the individual. Opportunity, this is the one that is within the control of the company, right? If there's no opportunity, and there are lots of ways that companies can institute internal controls to help reduce opportunity. So if you've got somebody who is under a lot of external financial pressure, maybe they've got a gambling problem, something like that, at their work, if there's no opportunity for them to commit fraud, if the internal controls are in place to prevent fraud from happening, then they're not going to be able to commit that fraud, right? But this is the one area where businesses have control. They don't have control over outside pressures that employees are under. Rationalization is where employees will, there's like, the best way I can describe this, I guess, is just use an example. So I didn't get that bonus last year. I always get that bonus. You know, my coworker over here got a bonus. They owe me money. I am due that bonus. I worked my butt off this last year, so I am owed that money. I haven't been given a raise in 4 years. You know, they should have been giving me a raise. They're rationalizing why it's okay for them to commit fraud. I suppose companies may have a little bit of control over rationalization in that, you know, treating employees fairly, making sure that everything is, that there's open communication. That can certainly help with reducing that, but I don't know that they have a way to 100% deal with this, because it's kind of at an individual level too. If somebody feels that they're a victim and they're hard done by, it's awfully hard to convince them. It can be awfully hard to convince them otherwise. But payroll is an area where there can be a lot of opportunity if those internal controls aren't in place. And like I just said, this is the largest expense area for most companies, and so it also means that there's the largest access to the largest amount of money within the company, and it's a regular ongoing process. So it's with a lot of transactions that are occurring. So there are lots of different ways that payroll fraud can occur. Some of them, identity theft. So obviously, payroll employees are privy to some very personal information about others, social security numbers, addresses, all sorts of information that could allow them to, open up credit in another person's name, and cause a lot of issues, and partake in identity theft. Buddy punching, and I don't mean like punching your buddy, but punching in and out for someone if there's a time clock, cheating on the time for when they're coming in and out. Ghost employees, this is when, and usually this is somebody within, well, it would pretty much have to be somebody within the payroll department. They'll create a false employee, and maybe so Kelly Westfall Murphy is an employee. Maybe we create a new employee whose name is K.W. Murphy. Close enough. so that if a check is created with that name on it, it will get deposited. It can be deposited into an account with my full name on it, right? So a ghost employee is where you create fictitious employees in order to commit fraud. Pay rate alteration. So obviously, somebody within the payroll department is raising somebody's pay rate without authorization, and maybe they're, a lot of times with this, there's also needs to be some sort of collusion that happens. So maybe you've got another employee that is bribing the payroll employee to fictitiously create a different pay rate. So instead of $12 an hour, $22 an hour, right? Worker misclassification, that as well. So misclassifying, the folks in the accounting department get paid more than the folks in the payroll department, so I'm an accounting employee instead of a payroll employee. There are lots of different ways, though, that employers can create internal controls, like I said, to help to mitigate the opportunity for all of these. All of these are, there are opportunity frauds, right? There's some lacking in the system that has allowed that to occur. One way of doing that is making sure that the same person is not in charge of, mandating vacations is one. And a lot of, and I'll explain to you why that's the case. A lot of frauds are discovered when an employee an employee who never misses work, is always there early, always leaves late, is never sick, all of a sudden they're sick. And somebody else has to perform their function. And they go in and discover that something is amiss. When you've got an employee that does not, they may seem like the best employee in the world, but they're very controlling. They don't want anybody else looking at their work. And so that's a great way for that employee to then take control and commit some sort of fraud. And a lot of frauds are discovered that way. Actually, the most common way that frauds are discovered is through anonymous tips.
Our biggest one at the post office was what we call time theft, is because routes are evaluated to 8 hours to the carrier. Now, when that carrier's on vacation, you put somebody who's never carried that route before, and they're getting it done in 5.5 hours
Right.
on their first day on it.
Right. You start to wonder, what's going on here? Maybe that 8 hours they're spending a couple of hours.
I ran into the carrier
Taking the
here
detour.
for EMAC yesterday. All of the city carriers said that they had undertime except for one, so they immediately went out and walked with him on his route yesterday.
Yep. Yep.
I was entering a company's bills at work the other day,
Mm-hmm.
and this made me think of this could easily turn into a fraudulent activities because I entered our own firm's bill for that company into their bills, so we
Right.
draft
You
their
could have
invoices.
charged them also. Yeah.
We draft their invoices and
Right.
bill them
Right.
for depending on what the client is, what
Mhm.
they're paying us to do for them. But I'm just like, okay,
Yep.
That is,
Yep.
that is one safety feature. So the
Yeah.
time roll thing that the post office uses for city carriers, clerks, and management is called tax time accounting control system. You can view your own, but you can't edit your own.
There you go.
And with
Yep.
the one that shows your vacation, when you put in vacation, you can't even see your own.
Right.
Somebody else has to do it.
Yep. Yep.
You can't even check what you have. You gotta
Yep.
get one of the other people to be like, how much vacation do I have?
Exactly. And so that's one of those internal controls where you're cross-checking. That's another one. So cross-training as well. So that's when I say, like the mandated vacation, if you have a couple weeks of vacation a year and you're not taking it, you have to take it. Like you're going to take it, and somebody else is going to come in who has been cross-trained on your job, and regularly that discourages, that reduces the opportunity for somebody to do that, right? To commit fraud. But payroll is an area where there is a lot of fraud that occurs. So it's a fascinating topic, fraud. And probably everybody has some sort of story that they can tell about a personal experience or something that they've heard, because there doesn't seem to be any shortage of
There was a big one, and they had to crack down. They found around the Des Moines area, they call them ghost postmasters, because their postmasters are on salary and they're on auto clocker. A lot of them would, when they left for lunch, they wouldn't come back. They'd only work 4 hours, take the 8. But they'd have a phone that they'd still answer while they were at home, but then they can't do anything because they're not at their computer.
Right. Yep, absolutely. So that's it. And yeah, it not just with, not just cash and stealing, or, stealing funds, but also stealing time. Definitely. All right. So, any questions on any of that? I know